Good morning, good evening, good afternoon, depending on where you are in this world. This is Hedge Lee, and I want to share with you some commonality in the current bear market to the past bear market. So if we look at the 2013-14 bear market here, we can see maybe a specific pattern that can be drawn. And I think this is looking maybe wedgy. So this pierced right through the bottom, came back up and broke above it. This here, therefore, was the buying signal. Okay, this was where you buy, even with a deep retrace, stayed above it. So that was the past bear market back in 2014. The recent 2018 bear market, I can do the same, I think, okay, where I can draw that trend line. Now, it does not look the same from a price action pathway perspective, but I think I can do something like this, where it again poked down below and broke above it. So that, again, here, right here was the buying signal to say, buy now. If we look at the current, we can say something like this. And again, it doesn't look exactly the same as what happened before, but from a boundary perspective of the pattern of the top and bottom, it's pretty well aligned. And I think if we draw this one like this also, and say that price goes from there to here and pokes below it. So maybe we go to, I don't know, let's say 13,000, okay, or 12,852.22. I think that's a little more accurate. And then it comes back in, but it breaks above it with a deep retrace afterwards. I think that looks pretty interesting. So the commonality that I'm trying to share is that past two bear markets had a downward wedge corrective looking pattern. And what we're looking at right now is really about the same. Now you might be saying, what the hell, why would you do this? I mean, this was not a bear market, but a standard bull market correction. So it was basically an opposite. These were bear markets, corrections within a bear market, okay, and this was a correction within a bull market. Now here, if I draw this, and by the way, you can go back all the way to 2020, I was calling this a fake rally, and we saw what happened on March 20th. So we can say that since this is an opposite, it's almost taking an opposite pattern. And that is a widening wedge, which is quite interesting to see because it is opposite. So this is a narrowing wedge, converging wedge, and this is an expanding wedge. But in both cases, here and here, when it broke above the top line, that was the buy signal. Okay, that was the signal at least saying the bull market is going to continue and resume. So when will we get this next buy signal? I think it'll probably be when this top line gets crossed to the upside. But you're going to say, well, we missed all of this, all of that, all of this. Well, there are other short-term ways to do entry setups. And my methods, or I guess my cocktail of methods, I use Hurst cycles. Okay, that's one method. Yeah, obviously, and I use Elliott waves. And the third method is what I call event analysis. This is a proprietary analysis. When all three jive, in other words, Hurst cycles, which is purely time-based, Elliott wave, which is primarily Fib-based Fibonacci price action, and event-based analysis, when all three say buy, 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 that's usually when we see this type of buying take place. But these can be used at all degree of trends. So the same cocktail of methods can be used as sub-daily analysis to give you early entries. But only members get that on a daily basis. Consider joining. If you like this video, consider subscribing and giving me a thumbs up. Have a good day.